Hello everyone. In this video, we're going to be going through the balance sheet liabilities and stockholders' equity. So first, we're going through current liabilities. These are obligations that will require the use of cash or the creation of other current liabilities within the next year operating cycle, whichever is longer. Just kind of a definition, given to us by the FASB. Just basically what is a current liability. Okay, it includes items such as accounts payable, unearned revenue, wages payable, short-term notes payable, etc. If a liability that comes due during the next year is refinanced, it is not included in current liabilities. Okay, this is something that is going to be covered extensively in a later chapter. Just kind of memorize that for now. Just sort of keep that in the back of your head. The conceptual understanding of it will come later, the actual numbers as well. You can list the current liabilities in any order. There's no specific order like there is for current assets, right? So if you've seen the current assets video, we talked extensively in that video about how current assets must be listed in a specific order, which is shown in that video. And if you do not use that order for current assets, you will lose points. For current liabilities and for basically the rest of the sections as well, all the other asset sections, the long-term investments, intangibles, PP&E, and other assets, and stockholders' equity and long-term liabilities, basically every other section other than current assets, the actual order doesn't really matter, but it's mainly just for current assets, okay? So just keep that in mind, all right? We also have this idea of something called net working capital. It's current assets minus current liabilities. It's used as a measure of liquidity, okay? And liquidity is just kind of like how quickly an asset is turned into cash or until a liability has to be paid, okay? So we're just trying to figure out, okay, fine, like, do we have more current assets or do we have more current liabilities, right? Because if we are in a situation where we don't have enough current assets, we may not be able to meet our current liability demands, right? Okay. Next is, that was basically everything for current liabilities. The long-term liabilities, basically they're obligations that will come due sometime after the next year operating cycle, whichever is longer. It includes items such as long-term notes payable, bonds payable, deferred tax liabilities, lease liabilities, etc. There are extensive disclosures are generally required for long-term liabilities in the notes of financial statements. Again, just kind of a conceptual thing to memorize. Do you necessarily need to know every single note disclosure? No, but should you kind of know just in general, there are a lot of, disclosures required. Yeah, you kind of should know that. Okay. Then we have owner's equity, also called stockholders' equity in our class, right? We're generally going to call owner's equity stockholders' equity in this class because we're generally dealing with corporations and we're generally dealing with people that own the stock, right? They're stockholders, right? So we have 6 main components of the stockholders' equity section. They are first, capital stock. This is just the par or the stated value of company stock. The second part is the additional paid in capital or paid in capital in excess of par. These are the same account name, just do 2 different names for the same account. This is any amount paid for stock over and above the stock's par or stated value. Okay. Then we have retained earnings. This is equal to the company's net incomes minus net losses minus dividends declared by a firm over the course of its existence. Okay. So it's basically any net income that we would have had. Okay. If we had any net losses, we would subtract those out, right? Because that reduces the amount of equity that we have. We reduce our retained earnings. And then we subtract out our dividends. Okay, that's going to be our retained earnings balance. Okay. Then treasury stock, the company's own stock that it has repurchased from stockholders. This is a reduction of stockholders' equity. This is actually called a contra equity account, right? And it reduces the balance inside in our stockholders' equity. Okay. Then we have AOCI, accumulated other comprehensive income. This is the accumulation of all items and other comprehensive income over the life of the firm. So in the chapter on the income statement, we talked about this idea of OCI, other comprehensive income. And so if we would just take all the OCI items for year 1, year 2, year 3, however long this firm's been in existence, and we just add those all up or subtract them or whatever amounts that they are, add, subtract, whatever math we have to do, we sum them all up and we will get AOCI. Okay, so AOCI is similar to retained earnings because it's just summing up all these items across time. Okay, retained earnings is summing up everything on the income statement and subtracting away dividends, but AOCI is summing up everything in OCI, other comprehensive income, those items that bypass the income statement that we talked about in the income statement chapter. Okay, non-controlling interest / minority interest. This is the amount of equity owned by the non-controlling shareholders. Again, not a big sticking point here. Just kind of know what the definition is, and that's pretty much what you should be required to know. Okay. The next thing is that for capital stock, the company must disclose the par value of its stock along with the amount of shares authorized, issued, and outstanding. Okay, we'll go through the definition of what those mean in a second, but on an exam, okay, you must list the par value of the stock, the amount of shares authorized, the amount of shares issued, and the amount of shares outstanding. Okay, and we will see that on the on a sample. I was just flipping to make sure I had it there, but I made a sample balance sheet, and we will see on that balance sheet what that means. But just as a quick reminder, we need to have these items disclosed on the face of the balance sheet. Okay, well, we'll see what that looks like in just a minute. Okay, what is authorized shares? Well, it's the total amount of shares the firm is basically allowed to sell over the course of its operations. It's the biggest of these three items. Okay, we can only change the number of shares that we're allowed to authorize by amending the articles of incorporation. Okay, so if we amend the articles of incorporation for the firm, then we're allowed to issue more shares. We're allowed to basically have more authorized shares. Okay, but that's the only way we can change the authorized shares. The number of issued shares, on the other hand, is the total amount of shares sold to stockholders over the life of the firm. And that's usually going to be the second biggest number. Okay, so just the amount of shares that we've sold to stockholders, basically. Okay. Outstanding shares are the amount of shares that are currently in the hands of stockholders, okay, other than the company. This is the third biggest, okay? So, meaning this right here is our treasury stock, okay? If a company is holding its own stock, if it goes out and repurchases its own stock, that's called treasury stock, okay? That's what we just talked about here at the bottom. It's a contra equity account when the company repurchases its own stock, okay, from stockholders, okay? That's called treasury stock. And those are not outstanding shares anymore, okay? They would still be technically issued because at one point they were sold to shareholders. However, they're no longer considered to be outstanding because they're not in the hands of just general shareholders. They're in the hands of the actual company itself, and so they're not outstanding. They're not considered to be outstanding anymore, all right? Now we just have a quick thing to clear up here in terms of just a little bit of housekeeping, kind of just terminology, and then we'll look at a sample balance sheet. The first thing is we have these different types of balance sheets, kind of you can think about, formats, types. The first is classified. It breaks up the balance sheet into subsections underneath the overall headings of assets, liabilities, and stockholders' equity, such as current assets, long-term investments, current liabilities, etc. So as we've kind of been going through for the past couple of topics, there's all these different subheadings within the assets category, within the liabilities category, within the stockholders' equity category, and that's what a classified balance sheet does. It says, okay, within assets, you have current assets, you have PP&E, you have all these different types, right? And so that's what a classified balance sheet does. Versus an unclassified balance sheet does not break up the balance sheet beyond just overall headings of assets, liabilities, and equity. Okay, so an unclassified balance sheet literally says assets, list all the assets, liabilities, list all the liabilities, equity, list all the equity accounts. Okay, there's no further differentiation underneath. There's no actual subsections, okay, like we've gone over before, like the subsections of long-term investments, current liabilities, etc. Okay, then we have two like technical formats, we can call them. One is account format, which is the assets are listed on the right side of the page. Okay, so the assets would basically be listed on like the right side of a page, and then we'd have a line kind of in the middle here, and then we have like the liabilities and the equities over here, but it's all on the same page. Just say we have the assets over here, liabilities, equities over here. Okay, report format is a situation where you just have like a really long piece of paper, and all the assets and liabilities are just listed straight down the paper. Okay, so that's basically most of the stuff for the balance sheet. Now we just are going to go through a quick template of a balance sheet that is in classified form with report format. That's like the most common type that you're going to see in this class, okay? And generally speaking, this is kind of the one that you would want to prepare on an exam, okay? So again, we have our three-part heading, which is basically the company name, the name of the statement, and then the date. Again, it's a balance sheet, so it's at a specific date, okay? Then we actually just list, we just straight up write assets in the middle, okay? And then we start listing our different types of assets, okay? So first we have current assets, and again, these have to be listed in a specific order: cash, trading securities, basically any short-term investments, just call them trading securities because that's generally what they're called a lot of the time. Then we have accounts receivable, less allowance for doubtful accounts, inventory, prepaid expenses, and then we want to make sure that we total up our total current assets. Okay, we want to just make sure that whenever we have more than one item within current assets or long-term investments or whatever bucket that we're in or section that we're in, okay, we want to make sure we total that up. If we have just one item, we don't necessarily need to total it. We still can, and it might be best practice to total it up, but you don't necessarily need to in that case. The other thing is just a formatting thing. Again, make sure that if you have multiple items that are kind of like the accounts receivable minus allowance for doubtful accounts equals the actual net realizable value of accounts receivable, make sure you just put a separate basically column here and then total it up. Go over and total it up and then just indent this a little bit, okay? Then you would have the next section as long-term investments. You list them all and then you would total those up, total long-term investments. Maybe just indent that a little bit just so that way we have a good format there. PP&E, again, just indent a little bit and then indent a little bit more for accumulated depreciation, but just list all those out: building, accumulated depreciation, total it up, have its own column here, okay? And then we'll total up our PP&E. Intangible assets, we list all our intangible assets, and then we have total assets. Again, like I said, we could have that other assets category. It's not listed here, but it's not there a lot of the time. If it was, we would just have another section called other assets, okay? Then we write, and we actually have to total our assets, right, like I said. Then we have our liabilities and stockholders' equity section, okay? Then we have to put that across the middle, kind of the same thing that we do for assets. Then we have current liabilities. We list all our current liabilities. We total those up. Then we go to the next page. We have long-term debt as a subsection. We list all of those. We total that up again, okay? Then we have stockholders' equity, and this is what I was talking about before. We have common stock, par value listed, authorized shares listed, issue share listed, outstanding shares listed. Okay, so we need to list all of those things on our actual balance sheet under the stockholders' equity section, okay? And make sure you differentiate that this is stockholders' equity after you have total liabilities, okay? Then you have your APIC, additional paid-in capital. You can kind of total that over. Retained earnings. Then from all of those things, you subtract out the treasury stock amount, which is why it's in parentheses. Then you total up your stockholders' equity, and then you have total stockholders' equity and liabilities come together. And then this number here needs to equal this number right here, the total assets amount, okay? And so those are basically the main things I will say about preparing the balance sheet, just tips and tricks. And so if you ever need to make a balance sheet, you can obviously refer to this as sort of a template, and you can use this. And that's the end of this topic.